It's the dominant theme in global macro and markets. But how has the breakdown of U.S.-Chinese relations changed since Donald Trump returned to office? Join our economists this fall for in-person briefings on global economic fracturing under Trump. We look forward to seeing you in Hong Kong, Singapore, New York, and London for a deep dive into the market risks and strategic challenges ahead. Sign up at capitaleconomics.com/events to join the conversation.
It's Friday, 15th of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, India in Donald Trump's firing line and the outlook for equities. But first, Neil Shearing, Group Chief Economist, joins me for another surf through the ups and downs of a week in macro and markets. Hi, Neil.
Hi, David.
It's 9:20 in the morning, Friday in London. That's 4:20 DC time as we're recording this. The Trump-Putin meeting is happening much later today. That's 3:30 in the afternoon, Washington time. We will have rapid responses out to clients depending on the outcome of that meeting. In the meantime, I wanted to start by asking you about that China activity data. So that's July industrial output, retail sales, and fixed asset investment that we've had just a few hours ago. What story is it telling about what's happening in the Chinese economy?
Well, it's a bit of a shocker, at least a shocker compared to what the consensus was expecting. And it's a shocker for a couple of reasons. One is that the numbers were weak, but they were weak across the board. So the story of the Chinese economy so far this year has been, as everyone knows, a property sector that is still in decline. There's still this big adjustment working its way through the real estate sector, a consumer sector that has been struggling but not collapsing, and a manufacturing sector that has been pretty strong because the export sector has been strong. So big expansion of supply in the manufacturing sector, and that's been funneled into exports. And that has been the key pillar of strength of the Chinese economy over the first half of the year. Now, when we look at the data that we've just had for July, that third pillar, that strength that's come from manufacturing appears to be weakening. The industrial data were soft, and there was evidence that that was due to softer exports too. Now, the authorities in China, of course, are still targeting this GDP growth rate of 5% or so over the course of this year. We've long argued that that's pretty hopeless. That's not going to happen. If you look at our own China activity proxy, that's suggesting that growth in the first quarter of this year was about 3.6% year on year. It slowed to about 3.5% year on year in Q2. And some of that weakness now seems to be showing up in the official data. So perhaps that gap that does opened up between the official GDP data and our cap might now start to narrow over Q3, but let's wait and see.
Weaker than expected growth. So if you look at the official numbers, as you say, our cap has been painting this picture for a while now, but what kind of response are we expecting from the government?
Well, this is a pretty familiar cycle now, isn't it? So what happens is you get some weakness in the first half of the year and then calls over the summer months for some policy support, and then optimism builds towards the second half of the year as we start to get some particularly fiscal measures unveiled. Now, the PBOC and all of this on the monetary side, I think, is still reluctant to cut interest rates. They're worried about the financial stability effects of cutting rates. And of course, to the extent they cut rates when the Fed is not cutting rates, that puts downward pressure on the renminbi and potentially causes renewed strains with the US. So I think the PBOC reluctant to ease policy. If we get many more months of this weak data, I'm sure we're going to get some speculation building in markets about the possibility of fiscal stimulus. But of course, as I say, we've been here before. For at least the last 2 years, at the back end of the year that I can recall, we've had fiscal support measures, and that's fed optimism going into the next year that we're going to get a pickup in growth. And we've always pushed back a bit against that, because at least a lasting pickup in growth, because to our mind, the fiscal packages that have come from China, they've always been limited in size and limited in scope too. So not much focus on really tackling the underlying fundamental problem in China, which is a savings rate that's structurally too high. So you need to really significantly shift the flow of income going to households and increase that. But there have been one or two measures in that direction, but never really enough to move the dial. And I suspect that's where we're heading. I suspect we'll see more measures in that direction coming over the second half of this year. Optimism building that fiscal support will lead to a pickup in economic growth over the coming quarters, but then that growth not really materializing because, as I say, it's more structural than it is cyclical.
So more weakness in China, and that deflation story isn't going away, which is my segue to get onto inflation. Because, and I want to get your take on this. You get points if you can guess who wrote this. Tariffs have not caused inflation or any other problems for America other than massive amounts of cash, capital letters, pouring into our Treasury's coffers.
I think there's one prime candidate here. However, the way that you've just described that suggests there's some punctuation, which is causing me to doubt myself. But I'm going to go with the 47th president.
Full point there, but I have to stress that was in between the past week's CPI and PPI reports.
Indeed. And those painted a bit of a mixed picture, didn't they? So if you look at the CPI numbers, some concern there for the Fed, but really because it's services inflation that has been strong rather than goods inflation. Obviously, you'd expect tariffs to be showing up in goods inflation rather than services. It was the services component that pushed up core. And it's something that the Fed should certainly be keeping more than one eye on. And then we got later in the week the PPI numbers, which did show potentially a bit of an effect coming through from tariffs, but also somewhat counterintuitively, given the take from the White House and others that tariffs are being absorbed in margins, there was some evidence in the PPI data that wholesalers' margins may actually be expanding. So maybe that'll push back against the idea that firms are absorbing these tariffs. Now, the long and the short of it is that when we look at the PPI numbers and the CPI numbers together, the Fed's preferred measure of inflation, core PCE, that looks like it increased by just over 0.3% month on month in July, which would clearly be inconsistent with a 2% inflation target. Now, some of that is services, some of that is goods. I think if we're being honest, that the pass-through from tariffs to inflation has not been quite as strong as we had expected so far, but there has been a pass-through. Is incorrect to say that there's no evidence of any impact of tariffs on inflation. And what's more, I think it's still too soon to say. If you remember what we were saying 2 or 3 months ago, I said that it would be in the July and August data that we would start to see an effect of tariffs come through, but really it would take Q3 and maybe into Q4 for that full effect to pass through. And so we're starting to see some effect in the July data, but it's not the final word, no.
And it's probably not coincidental that we didn't get the commentary from Donald Trump after the PPI release. But putting it all together, what is September now looking like? The pricing in Fed Fund futures suggests it's pretty much locked in that we're going to get a rate cut. Is that locked in?
Well, look, there's still 1 or 2 pieces of important data to come between now and that September FOMC meeting. There's another CPI report. There's another jobs report. However, I do think it looks increasingly likely that the Fed has been backed into a corner on this, leaving aside all the political pressure on the Fed and Powell to cut rates coming from the White House and now from the Treasury. When the market's pricing in a near 90%, 95% chance of a rate cut, you've got to have a pretty good reason not to cut rates, because otherwise you're going to see a pretty adverse response in the bond market and the currency markets that as a central banker you're probably going to try to want to avoid. So I think the Fed probably has been backed into a corner in September, and it would take something pretty extraordinary from the CPI numbers and the jobs numbers for August to prevent the Fed from cutting. But the key question to my mind, at least, is not really what happens in September, but what happens after that. And in particular, the degree to which the Fed's going to be loosening policy. Now, the market is pricing in cuts in rates all the way down to 3% by Q4 next year. So that's cuts of kind of 140 basis points, something like that, from where we currently are. It's not obvious to me that the US economy needs monetary support to that extent. If you look at the activity data, it's pretty clear that demand in the US economy is slowing, but there's also strong evidence that supply is slowing, and labor supply in particular is becoming constrained by the immigration crackdown. Inflation, as we've just discussed, core measures back above 3% year on year, core CPI. It looks like core PCEs now at a target inconsistent rate of over 3% month on month annualized too. In all of this, of course, the government has just passed a fiscal bill that's entrenching deficits of 6.5% of GDP or so, as far as the eye can see. So fiscal policy is supportive. And the labour market's not collapsing. Yes, hiring has slowed, but it's also the case that, as I say, labour supply appears to be weakening too. So it doesn't scream like an economy that's in massive need of monetary support to me. So yes, increasingly likely that we get a September cut, but the 140, 150 basis point cuts that some are talking about after that, and indeed the 50 basis point cuts that are being touted as a possibility in September, I just don't see the case for.
The cuts of this magnitude, 50 basis points in September, 150 basis points through the cycle, this is being fueled by Scott Bessent. You mentioned this political pressure that's coming from the Treasury now. He was interviewed earlier in the week. He was saying that rates should be cut 150 to 175. Then he walked that back subsequently and said, oh, no, that's just what the estimate of neutral is. But the fact is, you do now have a Treasury Secretary weighing into the monetary policy arena. Incidentally, in that meeting, he was also criticizing the BOJ. What do we make of this? Is it the case that we've got a Fed chair that the executive branch clearly doesn't like and wants to get rid of? So maybe it just doesn't matter. Bessent's leading the hiring of the next Fed chair, the nominations for that. They'll get their man or their woman in, and they'll revert to norms where they're not interfering in monetary policy matters. Or does this point to the institutional erosion that you were talking about over the past few weeks with this whole political fight over the BLS and the quality of the statistics that it's producing?
Well, I think the short answer is that nobody really knows. And I think one thing we can say is that the guardrails when it comes to monetary policy, they're pretty solid, right? That even if you get your own person in to chair the Fed, there's still only one voice amongst several when it comes to setting interest rates. And I think it's also fair to say that the names that have been touted so far, and apparently the search has been expanded now as well, notwithstanding that expansion, all the names that have been speculated about in the media, I think the market would characterize as pretty orthodox choices. There are no headbangers on the shortlist as far as we can tell. However, it's pretty worrying, not just that the Treasury Secretary's weighing in on monetary policy set by the US, but also foreign central banks. That's something that's not seen to be the done thing. But also the language that Bessent used. For someone that's normally relatively reserved, the language he used was something along the lines of that all models would tell you that rates should be cut by 150 to 175 basis points. Well, that's certainly not the case. If you look at a standard Taylor rule, actually, it would tell you, if anything, interest rates are probably appropriate, and depending on the parameters you choose, might be slightly too low at the moment. So it's certainly not the case that all models would point to lower interest rates. Now, as you say, he's tried to walk that back a bit and say, well, I'm talking about the neutral interest rate. Well, fine, but you're the Treasury Secretary running a budget deficit of 6.5% of GDP. So that, all other things being equal, would lead the central bank to be setting monetary policy in a more restrictive territory to compensate for the loose fiscal policy. So that's important to keep in mind. Now, as I say, there's not much when it comes to the macro data to justify really substantial rate cuts. The proof of the pudding, therefore, will be in the eating. If we do get a new Fed governor that comes in and the Fed cuts by much more than 100 basis points, starts to cut below the low threes and into the twos, that's happening without a significant deterioration in the economic outlook, in the labour market, or with some big downside surprises to inflation, then I think we can conclude that there is some political pressure being exerted on the Fed, and that is having an impact on monetary policy. And if that's the case, then I suspect we'll see the short end of the curve come down, the long end of the curve go up, and the dollar weaken. But really, until we start to see evidence of that, I think it is just speculation at this stage.
But also, it's interesting you say that would lead to lower at the short end, higher at the long end, when what he seems to want really is lower long-term rates. So cutting all that way, is he really going to get those long-term US rates coming down the way he wants?
I'm deeply skeptical, unless they somehow manage to trash the long-run outlook for the US economy. So if you look at what's happened this year, for example, I was looking at the screens earlier this morning. Since the start of February, we've seen the 2-year yield fall by about 30 basis points, but the 10-year yield in the US is broadly unchanged. So we've seen this steepening of the curve where the short ends come down, but the long ends remain unchanged. Now, that's not surprising, I don't think, because given what we've learned about fiscal policy over the past few months, given what we may have in terms of additional risk premia baked into US assets because of some of the policy shifts in the US. So I think to the extent we do get pressure being brought to bear on the Fed, then I think there's got to be a good chance that we get more of the same. That is to say, rates at the short end down, rates at the long end broadly unchanged, maybe even up a bit. It could weaken the dollar, though. I think they may have a bit more success in terms of weakening the dollar. And again, the administration sent some mixed signals on that, haven't they? Defending the strong dollar on the one hand, but also seeming to push for a weaker dollar as part of some redress to the US trade deficit. So yeah, maybe it's successful in terms of weakening the dollar, but in terms of lowering the 10-year benchmark Treasury yield, I'm a bit more skeptical.
Neil Shearing there on yet more attacks on the Fed by the White House, on the US inflation outlook, and on China's latest data haul. Neil mentioned our China activity proxy. I will add the latest read of that proprietary indicator to the podcast notes. Now, it was only a few months ago that India had been expected to be one of the first countries to get a trade deal done with the US. Yes, Donald Trump had complained in the past about India's tariff regime, but the president was also thought to have a good relationship with PM Modi, and against the backdrop of Xi Jinping's strategic ambitions, the mood music was positive. Fast forward to today, and relations are at their lowest point this century. A lot has been fueling this breakdown, though Indian purchases of Russian oil are the stated reason for the US taking tariffs on India up to 50% effective August 27th. Our India team has been briefing clients this past week on what this could all mean for India's macro and markets outlook, and for our assumptions about where India sits in a world of fracturing US-China relations. Here's a short edited clip from our drop-in, these are our short-form online briefings, that we held for clients earlier this week, in which you'll hear Deputy Chief EM Economist Shilan Shah and host Mark Williams, our Chief Asia Economist. The clip starts with Shilan talking about what a 50% US tariff would mean for Delhi's long-term economic ambitions.
Well, all else equal, you'd have to conclude really that this damages India's longer-term manufacturing ambitions if the tariff were to stay in place. It's currently, as it stands, facing a much higher tariff than those that have been imposed on some of the other major Asian economies, such as Vietnam, Philippines, Indonesia. Their tariff rates are something like 19-20%, something like that. So 50% obviously significantly higher. Going back to Joe's point on the effective tariff rate, even if we think about that, India's stands at 36%. So it's pretty close to China's at 40%. So if all of that stays in place, then yeah, the appeal as a sort of alternative to China for supply chain reconfiguration is going to be undermined, because it's just more cost effective to set up factories in some of those other Asian economies, for example. There is a sort of a zero-sum element to it, I think. I don't think it necessarily kills manufacturing ambitions completely. Firms are going to need to take a view on whether these very high tariffs outlast Trump's presidency, for example. India still has a number of other advantages which have always been in place, really, with the size of its labor force, the size of its domestic market, which provides a sort of tariff hedge. But yeah, a 50% tariff, I think, would certainly gum up the process of supply chain reconfiguration into India.
We've had a couple of questions on India's leverage. So I mentioned China demonstrated its leverage over the US by cutting off the supply of rare earths. Does India have any leverage versus the US?
Yeah, very good question. There's been a few questions along those lines. I think really in stark contrast to China, India has very limited leverage. It's not in control of the sort of supply chain of any strategically important goods in the same way that China is with rare earths, for example. India doesn't really import that much from the US. Retaliatory tariffs would be something of a blunt tool, I think. And the US can source most of the products it buys from India from other suppliers, which is a point that Joe has already made with regards to the textiles sector. So yeah, it does have very limited economic leverage, I would say. Doesn't have a great hand to play. I think the one bit of leverage that it perhaps does have is political. The US will be wary, or ought to be wary at least, of completely alienating India, because really it's the only country alongside Japan perhaps that is big enough to serve as a sort of strategic counterweight to China in the Asia Pacific region. So historically that leverage would have probably been enough to allow India to continue purchasing Russian oil, for example, which is what happened under the Biden administration. But it doesn't appear to be the case, at least on the face of it, for the Trump administration. So whether that proves to be enough leverage, I think still remains to be seen. But it is a small hand to play compared to China, for example.
There is a different path here, isn't there? A potential kind of future path in which India does cozy up more to China and sits on that side of the divide. As you say, the threat perhaps to do that is a bit of leverage. But how realistic do you think that is? I guess the chances of that have increased, but are they large? Do we really see a future in 5 years' time in which India and China are particularly close allies and there's a lot more distance with the US?
Yeah, I mean, there's certainly some diplomatic noises around that happening. It's pretty clear that relations between India and the US are currently at the low ebb. I think that's as much about Trump's tariff threats as it is by his sort of apparent or quite public attempts really to improve relations with Pakistan. That has upset many in Indian sort of policy-making circles. So I think it's a combination of both of those factors. I'm not especially convinced, though, that we're going to see a big sort of realignment in geopolitical alliances. I think anything that strains relations with the US would run the risk of diminishing India's appeal as a reshoring destination for firms. We know that's a really key priority for this Modi government. And if we're thinking about this through the lens of global fracturing, not really sure that significant improvement in relations with China is really on the cards. And I think underpinning that is the view within India that China poses a threat to national security. We've had this long-standing border issue in the Himalayas, which has been largely peaceful, really, for the past few years, but it's still unresolved. China still has close relations to Pakistan, which is seen as a worry within India too. Potentially a new source of tension with the construction of this major hydropower dam in the Tibetan plateau as well. So there are a number of security concerns, or at least perceived so, within India. I think it's been really interesting, even if we just broaden it out slightly beyond India. We think about some of the other BRICS, Brazil facing a very high tariff, South Africa as well. At least part of that, it seems to be politically motivated. We've had Brazil's President Lula talking about a sort of united response or a united front from the BRICS to US protectionism. But really, so far, they're only paying lip service to this idea of deeper cooperation amongst themselves. The priority for most at the moment just seems to be to limit the damage in their sort of respective relationships with the US.
That was Shilan Shah on the downturn in US-India relations. I'll link to a recording of the full drop-in briefing in the podcast notes, and also to Shilan's notes about the BRICS, which is the Brazil, Russia, India, China, South Africa grouping that he referenced towards the end of the clip. Again, we'll be publishing rapid responses to any meaningful outcome from that Alaska meeting between Trump and Putin, and there will likely be follow-up from our India team in the week ahead, so look out for that. On fracturing, don't forget our in-person events this September and October in Singapore, Hong Kong, London, and New York. I'll add a registration link for those events to the show notes. Finally this week, our markets team recently raised our S&P 500 forecast, including to 6,750 for the end of this year from 6,250. The team had cut its original N25 forecast back in spring from 7,000. And I spoke to Chief Markets Economist John Higgins about why they've decided to revise it back up, if only partially.
We began this year anticipating that the stock market would continue to do very well after envisaging correctly that it would do that last year. And we were forecasting that the index would plow ahead to 7,000, having roughly reached our end 2024 forecast of 6,000 towards the end of last year. We changed our tune, though, actually, in the spring for a couple of reasons. Reason number one was Liberation Day, and we just felt that if there really was going to be a dramatic escalation of tariffs that looked quite likely then, that there's some economic backdrops that simply wouldn't be conducive to the rally in equity markets that we've been anticipating. The second thing was that somewhat earlier than that, we'd seen the emergence of a potential challenge to the US's dominance of AI from China with the news around DeepSeek. So for a month or two really leading up to Liberation Day, we'd actually seen the big tech sectors in the US struggling at the expense of those in China, which were sort of taking off. Now, our faith in like AI as a transformative technology hadn't been shaken. It's just become a bit more equivocal about the ability of US big tech firms to really capture and dominate that in the way that we had previously foreseen. So it's those two things, really. A little bit more on the fence about the US's ability to dominate AI and what happened around Liberation Day that caused us to become much more conservative about what would happen. And that's why at that time we revised the forecast all the way down to 5,500, which seems pretty dramatic given the previous forecast, but actually wasn't that big a drop relative to where we were at that point. Now, since then, of course, things haven't turned out as badly as we thought. For example, on the tariff front, yes, they're a little bit higher than they were before the trade war kicked off and arguably a bit higher than we'd envisaged. But it's certainly not as bad as it could have been. And if you look at the reciprocal tariffs that were modified and announced for most countries at the end of last month, they were, in the vast majority of cases, lower than we saw being announced on the 2nd of April in the Rose Garden. So I think, we're not out of the woods completely on the tariff front, but things haven't panned out as badly as they might have done. And then when it comes to the AI story, what's also become clear over the last couple of months, really, is that both the US and China seem to be able to enjoy, if you like, the benefits of this renewed enthusiasm for AI that's taking place. So we're seeing strength both in the big tech sectors in China and in the US. So again, whilst we're still not absolutely convinced that US big tech sectors will be able to monetize AI as effectively as we'd previously envisaged, certainly looking a healthier picture. So I think it's a sort of unraveling of those two things that caused us to downgrade our forecast in the first place, which explain why we've pushed the numbers back up almost to where we were previously, but not the whole hog.
I'm going to put myself in the role of devil's advocate here because, there's a number of risks that is probably worth ticking off as you explain our view. The most obvious one is, aren't stocks now looking pretty expensive, either on a P level or versus bonds? So give us a sense of the valuation story.
I think too much is made, actually, of the valuation of the stock market being unsustainably high. Our story all along, really, certainly when we made the initial forecast of 7,000 for the stock market at the beginning of this year, for example, was that we would see the valuation of the stock market creeping up towards the peak that we saw in the dot-com era, when the price to forward 12-month earnings ratio of the S&P 500 as an overall index reached around 25. And right now we're around the 22 to 23 type of level. Our forecast for the end of this year assumes we'll tick up to a little bit over 24. So is this high? Well, yes, it's high by the standards of the past when you're looking at the average. It's not as high as we got to in the dot-com bubble. Again, we feel like we're in the process of an emergence of a new transformative technology like the one that we saw then, that's likely to be accompanied by some comparable increase in valuation. We think it's not implausible that the valuation of the stock market will continue to creep higher, even if it's above the average. You also mentioned about relative valuation. Of course, the level of bond yields now in general is much lower than it was 25 years ago or so when we were looking at the valuation of the US stock market and wondering whether that was sustainable. And on relative terms, certainly the gap between the valuations of equities and bonds suggests to us there's also plenty of scope for the stock market to go up. That's point number one. We think valuation is high relative to its long-run average, but it's not unsustainably high. And indeed, our forecasts assume it will inch up a bit more. The second and important thing I think to note is that to the extent there has been a bubble or is a bubble emerging in this transformative technology of AI, it's certainly more a bubble in earnings themselves than it is in the valuations of these stocks, I think. And that is a bit of a contrast to what we saw 25 years ago when it certainly within the big tech sectors, it was more of a valuation driven rally rather than an earnings driven rally. So I think what you need to be focusing on is not just, whether the valuation of the market is unsustainably high, but whether the earnings themselves are unsustainably high. The jury's a bit out on that. Clearly, the earnings within the big tech sectors have been growing very rapidly. Many people take the view that this is itself unsustainable, the growth rate of the earnings that we're seeing there. In some cases, margins are very high and look vulnerable to being squeezed. But our overall sense is that demand for AI is strengthening, that companies who are dominating that landscape at the moment are continuing to enjoy healthy revenue and earnings growth. And we don't see a reason why earnings should suddenly collapse or expectations for them collapse, particularly given our view that the economy in the US is likely to hold up reasonably well, especially now we're seeing some de-escalation of the trade war. And of course, the dollar has actually gone down rather than up, which should also help the sort of big multinationals in the S&P 500 that are trying to deal with potentially, to some extent, eating some of these tariffs via a squeeze on their margins.
But how much is if we look at how much of the capitalization of the S&P has become about this small group of tech firms, how much, when we're talking about the outlook for equities and this bullish story you're telling, how much of that is riding on this AI story? What does the rest of the market look like?
A lot of it is riding on the AI story, and the market is definitely very concentrated, if you want to use that sort of adjective to describe it, insofar as the big tech sectors and the largest companies are, account for an unusually large share of the market capitalization of the index. I mean, clearly that's something we did see during the latter stages of the dot-com bubble before that burst. So to some extent, you're right, if that's what you're suggesting, that a lot is riding on the AI narrative. It's just that we don't see that AI narrative faltering imminently. It may falter if we reach a point at which the valuation of those sectors becomes excessively high in the eyes of investors, as I said, but that's something we sort of are envisaging a little bit further down the track, so not imminently. As far as the rest of the market is concerned, though, David, things do seem to be slowly improving. For a while, their earnings in sort of the other sectors outside the big tech sectors were broadly flatlining, but they've generally been rising over the last year or so, not dramatically, but I would say the direction of travel is up rather than down, which is obviously constructive for the overall earnings of the stock market. Is that likely to remain the case? Well, our sense is that it will. I think in an environment when the economy holds up and doesn't go into a recession, it's more likely that earnings will continue to grow in the broader sort of non-tech sectors. Obviously, some of them are volatile and exposed to specific things, whether that's, for example, the energy sector and supply of oil and how that affects energy prices, or potential imposition of industry-specific tariffs through Section 232. That could obviously have a bearing on particular sectors, like healthcare, for example, depending on what happens there. But I think if you sort of just take a more holistic view and think about the overall prospects for these non-tech sectors, I think our view would be it's generally reasonably favorable, even allowing for the fact that their margins might be squeezed a little bit by the tariffs that we have seen put in place.
It feels to me like the perhaps key risk is Trump-shaped. Your colleague, Jonas Galton, has spoken about this paradox that the higher the market rises, the more emboldened the president becomes in terms of the kinds of policies he's rolling out. Just in the past week, we've had reports of export tariffs on some of these listed firms. There's now talk of the US government taking a stake in Intel. It all sounds more and more interventionist. So what is the risk here that ultimately we get a policy mistake, Trump doesn't back down from it, and that really does ultimately threaten the bubble?
Well, we have seen, that the market is prepared to revolt in the right circumstances when it feels it's appropriate to do so. We obviously saw that in April after Liberation Day, when we had a meltdown in the stock market that initially didn't prompt a change of heart from the administration, but then we had a meltdown in the bond market that did seem to change the tune. And clearly, ever since that pivot, if you want to call it that, from the administration, the mood in the markets has generally been a lot more positive. So I think it's certainly possible that something could upset the apple cart if the president became so emboldened that he made something that was a policy mistake in the eye of the average investor. But right now, it's not obvious that he's making those mistakes in the eyes of the average investor because, the stock market's basically a record high, bond yields have settled back down. So for all we talk about, we can't trust the economic data anymore because of decisions about who's running certain government economics agencies, or undermining potentially the independence of the Fed by criticizing the stance of monetary policy, or even, as you alluded to, charging certain US tech firms for exporting chips to China. All of these things in and of themselves, you think, well, potentially they could be unnerving for investors. But right now, they just don't seem to be bothered by that. I think it would take something pretty substantial, really, for the apple cart to be upset in the way that it was back in April. It's not something we're envisaging as a base case. I think perhaps more worryingly is the sort of idea that all of this interference, if you want to call it that, in policymaking or in institutions could be more of a slow burn process where it doesn't have any necessarily immediate effects on markets, but slowly erodes investors' trust in policymaking, in the confidence of institutions. And that ultimately could have a bearing, I suppose, on the absolute and relative valuations, for example, of US assets. But again, I think this is something that's perhaps more likely to materialize with the passage of time than in the near future.
That was, though, that idea that there'd be a risk premium suddenly on US assets. That was a very live conversation back in sort of around April, around the Liberation Day tariffs, maybe just a bit before that. And part of that conversation was, on a relative basis, other markets are going to do well now because of the policy risks associated with the US. So Europe, most often spoken about in that conversation. With all that you've said now about this returning confidence in the US equities outlook, does that leave the rest of the world behind? Is this exceptionalism play that's been spoken of over recent years, is that now back in effect?
Well, I think it is back in effect. You can see that in the relative performance of markets of late, right? Since Liberation Day, the US has been leading the charge again in a way that it clearly wasn't doing in the run-up to and around the immediate aftermath of Liberation Day. And I think, there are two sides to the coin here. Obviously, there's, what does all of this mean for the US market itself? And were, for example, the president's policies really going to damage the US economy substantially? I think there was a view that maybe if we'd seen a massive escalation of tariffs, this could be really quite bad for the US itself as much as anybody else. Also, I think there was a widely held view that by imposing tariffs on the rest of the world to an extent that they wouldn't probably retaliate in kind, this would probably lead to an appreciation of the dollar that would reinforce the difficulties for the US economy. But of course, the dollar has actually fallen rather than strengthened. So that's been a tailwind, if you like, for the US economy that many hadn't envisaged and helping to offset these tariffs. Of course, the data have generally continued to come in reasonably healthy. And, the president has made the observation that, the economy, paraphrasing, hasn't sort of fallen off a cliff in the way that many people had anticipated or projected that it would. So where's the evidence for all of this? Clearly the July employment report that, prompted Trump to fire, if you like, the former head of the BLS was perhaps a worrying sign. But more generally, I think the data have been pretty constructive and reflective of an economy that's operating, at or around potential in a fairly healthy way. We also haven't seen the big increase in inflation that many people had feared as a consequence of tariffs. Now, maybe that's a lagged thing and we'll see it in the coming months. And to some extent, that's what we're anticipating. But the pass-through into US consumer price inflation just hasn't been as large or happened as quickly as we and others, I think, had initially anticipated. So, I think the sort of change of heart, there's been a bit of a change of heart about what all of this means for the US itself. And of course, that change of heart has also helped facilitate a renewed enthusiasm, if you like, for the AI sector, because you need a reasonably healthy economy generally for a bubble to form and inflate. It's much more likely for enthusiasm around AI to resume if economic conditions are holding up and looking okay. But as I said, that is one side of the coin. The other side of the coin is, if we think about Europe, for example, a lot of Europe's outperformance earlier this spring was sort of, yes, it was connected to Trump's policies and the way that they might result in fiscal expansion in Europe in order to fund defense spending or other things. And clearly we saw a strong performance from parts of Europe connected to that, not just to the prospect of increased defense spending, but spending on infrastructure. So a sort of looser fiscal policy stance that been pushed for by the US president certainly contributed to a very strong performance from certain parts of the European stock market, particularly like industrials, for example, and financials, because bond yields rose in response to the prospect of having to pay for all of this. But that seems largely to have run its course. That's sort of a bit of a one-off boost, really. And I think if you sort of step back and look at the relative prospects for the two economies in the US and Europe, again, I think we would argue that it's not obvious that it's much brighter in Europe than in the US. And certainly if you were to take a step back and look at how have earnings per share, for example, grown in the US versus Europe over the last sort of 10 years ago, and you looked at that, the ratio of those two things, and compared it to the ratio of how their economy's GDP, for example, had evolved over that time, there's a reasonable relationship. Now, obviously, there are all sorts of reasons why there might be difference between rate of GDP growth and rate of earnings growth. But I think it speaks to the idea that you can't reasonably expect Europe to outperform the US over time unless Europe's going to start growing more rapidly than the US over time. And I don't think there's a lot of evidence for that. So to answer your question, I think US exceptionalism is back. It's justified given the relative outlook for economic growth in the two countries. And it's justified, in our view, by the fact that the big sectors obviously have a much bigger share in the US stock market than they do in the European stock market. So to the extent that you believe in AI as a transformative technology and that this will be the main reason for an ongoing rally in stock prices, then to our mind, at least, that should favor the US stock market again over the European stock market.
John Higgins on the outlook for US stocks and why that US exceptionalism trade is back. I will add a note explaining the upgrade to the podcast notes, so do check that out. But that's it for this week. We will be back next week with a review of the latest UK inflation numbers, a look ahead to Jackson Hole, and much more. Until then, goodbye.